Hey guys, so here is a challenge that this video is going to help you save lakhs, and if it does not, then you can dislike this video. All I'll request are two things. Number one is that please watch this video till the very end with the intent, with an open mind, right? So that's all I ask you, right? That please watch it with that lens. Second is that whatever I'm talking on this video, please go and double check it, right? So use like tools like Perplexity or chat GPT, whatever you use, double check it, because you don't need to trust anyone, including me, whatever I'm telling you, okay? So 10 points. Number one point is that the way retail investors are losing money into the stock markets right now is very simple, that they are investing in suboptimal things. Now, what are suboptimal things? See, stock market is basically a forecasting game. It's probabilistic game. It's mathematics. You are playing the odds. That's it. For example, people play the odds that, hey, is the world going to de-dollarize? Or is INR going to fall or rise? These are all odds. The odds need to be in your favor. So the first way retail investors are losing crazy ton of money into the stock market is that they play bad systems and bad things. For example, you would have heard that a lot of traders lose money. Why? Because mathematically, it's a poorly designed game in India. How exactly? For example, if you are an FNO trader in India, okay, then in India, or India has one of the highest short-term capital gains tax in the world. So you are, even if you win it, you're still going to lose crazy shit ton of money. Okay, that's one. So now you might say that, okay, fine, I don't do FNO, I'm an investor. So tell me, like, how does this mathematical odd things works for me? Okay, see, think about it this way, that if you study something like dollar depreciation, now many of you would be commenting that, you know what, dollar is going to de-dollarize, Donald Trump is idiot, this, that stuff. So you would like, get iffy, who will go and invest in like US market, okay? But if you actually look at data, and here is the data for you, right? Because you're an investor. So I'm focusing this conversation for you. So this is a tweet that I did, which triggered a lot of people. So I will just pick the data from this. Again, go and fact check it. You don't need to trust me, okay? So for example, Nifty 50 has delivered 11.25% CAGR in INR terms over the last 10 years. This is a fact, okay? And let's say that you are investing in the Indian market in the last 10 years. Now, in the last 10 years, what has happened? That INR has depreciated compared to US dollar by 42%. So if you then calculate the CAGR, it comes out to be roughly 6.5%, okay? Now, if you compare this, because 10 years ago, you might be making the choice that, you know what, should I go and invest in the US market, or should I pump in more positions in the Indian market? So if you picked like the Indian market, then honestly, what has happened is that S&P 500, I'm not even talking about NASDAQ, which is tech, okay? That has given crazy run up. But S&P 500, which is the broad index in the US, that has generated 12.5. So long story short, if you adjust it for INR depreciation over the last 10 years, Nifty 50 has underperformed the US market or US broad index by a lot. This is not even a competition, right? So what odds am I playing? I'm actually building a US portfolio. I have built a lot of positions in artificial intelligence. That is the industry that I feel very, very bullish about. I'm making some of my portfolios AI first, almost entirely AI driven bets. In case you guys are interested, I'm putting the links in the description comment box. The alpha on that community right now, I started that in January. It's more than 16%. So I'm beating NASDAQ by more than 16%. In case you guys are interested, I teach everything from scratch. You will understand things better. In case you are new to US stock investing, you will learn a lot of nuanced things about US stock investing, AI. So these are topics that I will teach from a beginner friendly lens. Okay. So you can check it out in case that appeals to you, right? So I am taking a bet or playing the odds on the US market more compared to the Indian market, because I feel that from a macro lens, INR will continue to depreciate. Our markets are not that great right now. I'm not saying it will forever be the case. There are always cycles, but right now it makes much more logical sense to play the odds. And people who do not play these type of macro bets or mathematical odds usually lose a lot of money, right? So this is point one. Now, point two, retail investors lose money because they chase the market or they chase certain segments of the market. So for this, let me use the example of Nifty 250, and you can use like mid-cap 150 also. I'll just show you like an example, quick example, because this is recent, okay? For example, this was a massive rally, right? This happened. In fact, if you have been my YouTube community member and if you have been following my channel, you would know that we were able to capture this entire gain. Almost 100% returns we made in a single year. And then we exited the small cap index and mid cap index. Now, here, if you see that, when do you think people or normal retail investors, beginners get excited about investing? it is on this curve. I'm not saying that people will get excited exactly at like this point or this point. I'm just saying that generally they would buy, or retail investors will buy on this rising curve. This is probably the worst time to buy, because in order to make money on this rising curve, you have to be extremely lucky. And what has happened with a lot of retail investors, that they started chasing this small cap 250 market. Like when? Like last year, people are making like crazy shit ton money in like small cap, I'll also go and buy small caps. So then they started chasing this market on this curve, right? And since then, what has happened? The market peaked here, then they had to witness a fall. Then there was a rise, then they thought that, okay, you know what, when I reach like my previous position, I'll sell it. So the market is now consolidating like this, okay? So there are always like three types of phases in the market. One is an uptrend, right? So this is an uptrend. Then there is a side trend, right? This is what a side trend looks like. And then there is a downtrend, right? What you need to do is that you need to buy the downtrend, or you need to buy a consolidation phase. You should not be buying here. This is an important bit. Okay, this happens every time. For example, if someone chased the market, let's say here, and there were people who entered positions, let's say at ABC, okay, then what happened? Then for like 1.5, 2 years, in fact, almost 3 years, this index gave zero returns. Now, this type of situation plays out on Nifty 50 also. This plays out on QQQ also, which is Nasdaq, S&P 500 also, global markets also, everywhere you look at it. So the fastest way of losing money, or one of the key reasons why retail investors lose money, is because they chase the market. So this is the meaning. Chasing the market means that chasing the uptrend. Point 3, the reason or retail investors why they lose money is because they fall in love with history. With the advent of stupid podcasting, right? Stupid podcasting means कि 2 घंटे सुनते रहेंगे, right? I mean, bakwas, right? I mean, some investor invested in like 1980s. Now he built like X amount of wealth, and therefore his viewpoint is relevant in 2025. See, I'm not being a cynic. Listen to everyone, no problem, right? Listen to me also, listen to 100 different people also, not an issue. But use your brain at the end of the day. For example, let me tell you this. Many people, and let me work with a very specific example, and this is an example that I love to give like on several of my videos, so I will just recap it here. For example, if you study Nifty 50, what people say is, and many podcasters are saying is that, hey, you know what, boss, invest your money for 20 years in Nifty 50 and you will see the magic of compounding. Then some genius will come, they will create like some very well elaborate Excel spreadsheet, you will get enticed, and then you will start pumping money. Now, is that sensible? Honestly, no, because you have to understand history in context of things. You need to have deeper view on things. So let me break it down, and this is an example that I love to give. So for example, if you divide Nifty 50 into 3 phases, okay, so this is phase 1, this is phase 2, this is phase 3. This was the early stages of Nifty 50. This was 1999, right, say all the way till 2009. Now during this phase, our markets went from 1x to 5x, okay, so यहाँ पे Nifty था almost 1000 points. And here it went to almost 5,000-6,000. So this was 5x growth. Okay. In this second phase, roughly like 2010 to 2019, 2020, we went 2x. And in this phase, from here to here, right, from here to here, we are again at 2x. So that story looks very beautiful, that if you put money for 20 years, we will see like massive growth and all that. But by see what the trend is like. Do not just fall in love with history. This is the worst way of investing. Now, this happens at a segment level also. For example, if you go back, look at like, podcasters, what they were saying 5 years ago, that emerging market, fastest growing economy, this, that stuff, very fast growth is going to happen. Okay, fine. Then 2025, what again? Oh, fast growth, 2025, like, emerging market, this, that. Bhai, emerging market hi nahi ho pa raha, emerge nahi kar pa rahe, right? So, I mean, you have to have like a rational viewpoint in terms of investing. Again, not dissuading you. All I'm simply saying is that do not fall in love with history. Understand the context more. For example, understand why this happened, right? Why was this 5x? Why was this only 2x? Look at the trend and then try to guess what is going to happen in the next 5 years, right? Because this phase 3 is only 5 years old, right? So we are looking at a decadal phase, right? So on a 10-year basis, what is likely to happen? Is this going to go to 5x or is this going to retain at like 2x? Because you're putting so much of your family wealth. And if you're not even like, doing like any level of analysis of why certain things are happening, and you do not have any scientific viewpoint on things, data-driven viewpoint on things, and yeah, there's just no point in investing. You are just better off picking a good index. Now, what is a good index? I will talk about subsequently on the video. Okay. So I hope that this point is clear. Next point, the way retail investors lose wealth is crazy commissions. Now, commissions are a curse. They are really, really bad. People do not understand the gravity of commissions. I again always use this example. Let's work through an example. For example, if you are investing for your kids, if you are 20 years old, 30 years old, you're investing for your retirement. So you might be using a time period of 40 years. It's reasonable to expect. Now let's say that you're making a monthly investment of 25,000 rupees and the expected CAGR is 12%. Now why did I pick 12%? Because this is what the average CAGR for the last 10 years is. So I'm just using it as a reference point. So 12%. Now what is the total corpus? The total corpus is 25 crores or 24.5 crores. Now let me change or adjust it for commissions, because a mutual fund or a PMS, for example, might charge you 2% of AUM. A mutual fund might charge anywhere between like 0.5% to 1%, etc. Right? They might have entry load, they might have exit load, etc., etc. Right? So all those things are there. So 1% pakad lete hain, right? So let's pick 1% and change it by 1%. Okay. Now how much did your portfolio change? Right? So here it became 18.5. Now on a base of 18.5, in the previous calculation it was 24.5 minus 18.5. This is 6. So on a base of 18.5, this is 30% change in your portfolio just with 1% addition of AUM. Now, many again like start arguing that, you know what, mutual fund managers are like experts. I just go and check the last 1 year returns of mutual fund managers. If they were such great experts, why are they unable to beat me, right? For example, here's my portfolio. I'm generating like crazy alpha, right? Why are they unable to beat me? Again, I'm not bragging or anything. I'm just simply telling you that it's not as if that they are experts and they will, you know, continue to beat everyone and retail investors can't beat them and all that. Commissions are sure shot loss. Try to avoid commissions as much as possible. If you are a serious investor, learn investing. It is worth investing your time, effort, money on. Now comes the next point, that majority of retail investors do not understand the meaning of valuation. For example, again, let's work through like this example, what we were studying earlier, small cap 250. Now, the way people will think is that, you know what, yaar, ye bahut zyada bhag gaya hai, right? And, you know, I'm sitting on a profit of like 50% or 100%. Therefore, I should sell it. Then some will say that, oh, gir gaya hai, right? I mean, it has fallen by like 30%. So I should buy it. That's not how it goes. You need to understand that at every point, what is the valuation matrix? For example, if you're trying to analyze the valuation of an asset called as small cap 250, if you are analyzing the valuation at point B for small cap 250, if you are analyzing the valuation of point C or A for small cap 250, you must have a grip of what valuation says. Now, there are different ways in which valuations can be done. For example, sometimes we use PE ratio, right? Then we use something called as enterprise value to EBIT ratio. Okay, so all these different valuation ratios are there. You must at least know the basic difference. For example, we might use something called as price to book ratio, right? That's again a different valuation analysis way. You must understand what is relative valuation. For example, Indian markets, you have to compare it to US market. Are they over or undervalued? You must understand the historic valuation. For example, small cap 250, how is it historically valued compared to its current valuation? Then only, as per today, for example, you might be thinking that, hey, this is a great buy. Should I go and buy now? Well, the answer really depends on your ability to at least understand or grasp the basics of valuation. This is the most important bit. Now, this does not mean that you can correctly predict it. Valuation exercise, if I have to give you a parallel, it's like saying that, hey, Sachin Tendulkar uses net practice, right? I mean, he was such a skilled player. He made like so many centuries, more than 100 centuries, I think. So, and despite that, I mean, before a match, he would go and practice in the nets. Why? Because he used to practice his technique. He used to refine his hand-eye coordination and bunch of different techniques that he used to practice, okay? What was the objective of that practice? Well, the objective of the practice was to maximize his chances of making runs. Now, when you do these valuation exercises, it's not as if that you will not take a loss in the market. You can. Very similar to how Sachin can get out on the first ball in a match. Similarly, if you practice all these market skills, what it allows you to do is that it allows you to optimize your return. Sometimes some of the valuation exercises that you do might turn out to be right. Sometimes wrong, but at least you will have a grip of whatever is happening. But if you're clueless, then nothing can be done. Then comes the next point, that retail investors take a lot of loss because they are greedy and they are under-diversified. Now, what is the meaning of under-diversification? It means that, for example, if you have a portfolio, right? I mean, of course, you're not going to go and buy only one stock, okay? you have to have at least 20 stocks in your portfolio. Now you'll say my portfolio is like, only like 30,000 rupees. Then again, you need to have 20 stocks. Okay. Now why? Because see, you do not have all the information as a normal small retail investors about company. Therefore, you have to spread your bets. So maximum that you need to invest in any asset, be it whether you are buying HDFC Bank or Hindustan Unilever or Amazon, Google, whichever company you are buying, do not invest more than 5% of your capital. Then I get a counter question that, hey, you know what, Mr. Warren Buffett says we have concentrated portfolio. Which brings us to the next mistake, that if you are a goldfish, do not behave like a shark. Okay. Mr. Warren Buffett invests $350 billion. How much money are you investing? Maybe like 1 crore, 5 crore, 10 crore, right? Compared to his $350 billion, he can move the market. For example, if he decides to sell Apple stock could fall by a lot. He's moving the market, right? So by the time he liquidates his 50 billion worth of bets on Apple, he himself will go into a loss on that stock, okay? The advantage for us is that we have no liquidity problems in the sense that we can liquidate our positions very easily. Then comes the next point, that retail investors do not make a lot of money in the markets because they have no cash positions. Now, what is the meaning of cash positions? Now, cash positions means that, for example, when you're buying growth stocks, for example, you might get very excited that, hey, Akshat speaks about like AI, all these growth companies and fast growth companies and all that. So I'll go and put like, if my budget for stock market is 10 lakh, then I'll go and pump up like 10 lakh into the market and be done. Then market corrects by 20%. Then you are just sitting. Why? Because you have no money to downward average things. So what is the lesson from this story? The lesson from this story is that, see, if you have growth stocks in your portfolio, growth stocks are fast moving tech-based companies. If you have these type of stocks in your portfolio, always, or like majority of the times, unless the valuations become cheap, you should have a 20% cover. So always do like 80-20. This is very, very important. Now, this is a little bit a harder skill to learn. You will go through your own set of experiences in terms of investing. You will refine this technique further. So this is a good starting point to keep in mind, that if you are buying high growth companies like Apple, Google, Nvidia, AI-based companies, tech companies, and if you say that, hey, my portfolio is growth portfolio, then at least have 20% cover, right? So that you can buy significant drops. These are called as parabolic drops in the market. So let me show you an example. So for example, here is a company. This is called as UNH. This is a US-based healthcare stock. I'm currently adding it to my portfolio. And you will see that from its peak, it has corrected by almost like 65% odd. And this drop, or this type of drop, is called as parabolic drop. Okay, it just literally like got crushed, right? Now, this does not mean that it will not come back up, right? This is a multi-billion-dollar insurance giant. It will come back up, but you must understand when to buy more and have the money to buy more so that you can ride this wave, right? This wave that I've just drawn. So you should be able to ride it, because these type of waves happen. This is a small wave. Let me draw it again, right? So for example, this is a small wave, right? This might be a big wave, right? Something like this might happen, right? Or another way that this wave could play out is that this was a wave. This might be a sharp recovery, and then another wave like this could happen, right? So this type of stuff can happen, and you can benefit from it only when you have certain cash positions aligned. Okay, so the next point that retail investors do not understand is the concept of risk-adjusted reward. Now, in finance term, this is called as Sharpe ratio. And easy way to explain this is that, let me explain you two case studies, right? So for example, if you go and buy Bitcoin, right? The upside might be that, okay, Bitcoin is trading at $100 and it can go to $200 in the next 5 years. But the downside is that Bitcoin can go from $100 to $50. So what is the risk reward here, right? So the risk reward is 2:1. Now, if we consider bet 2, so for example, TCS, the upside in the next 5 years might be that, okay, $100 become $150. And downside is that $100 could become $50. So which bet will you take? Well, mathematically, you should be taking this bet. Because here, the risk reward is 2:1. Here, the risk reward is 1:1. Now, how to build this risk reward system is, again, retail investors have no clue about. So they just randomly go pick like a bunch of stocks. In Bhai Sahab ne podcast mein ye bol diya tha, I'll go and buy this stock only. And then they keep on blaming like, aapki wajah se itna gir gaya, and aapki wajah se itna gir gaya, and all that stuff. And these type of people never make any money in the stock market because they are clueless investors. Which brings me to the final point, that retail investors should really think about understanding what a business is. Now we keep on hearing about that, do fundamental analysis. For example, you go to a shop. That shop is very well run. The owner is very friendly. He speaks to you really well. The staff is very efficient. They have good tech. They are able to process your orders really fast. They have a home delivery system. They market really well. So you can say that shop is very nicely run. They have great operations, great customer care, good owner, entrepreneurial, right? Doing new things. So that's a good shop. Similarly, you have to identify good businesses in the market. So this is what retail investors should think about, that where are good markets? For example, is US market a better market? India market a better market right now? Which industries? Is AI a better industry or is FMCG a better industry? It's because ultimately, what are you investing in when you are buying stocks? You are buying businesses. And those businesses in the next 5 years, 6 years, they need to do well for your money to grow. And trust me, right? I mean, if you are putting money at a decent valuation in a good business, your portfolio will grow really fast and really well. So I hope that this video changed your perspective on investing. It at least gave you 1 or 2 execution oriented points. If it did, do subscribe to the channel. It would mean a lot to me. And thank you so much for watching. I'll see you soon.